Everyone, this is Rahul with the Alternative Investors Hangout, and today we have a very special guest. He is David Morgan, and he is the Silver Guru, and thanks for coming on again, David.
Rahul, it's my pleasure. Thank you.
All right, so I'm looking at silver right now. It's $28 an ounce. I think the last time we talked was right before silver just crashed in February. I think it was Leap Day, where Ben Bernanke was showed up by Ron Paul, but this time around, silver is, I think, $9 down from that time frame, or $8 around that frame. But what I wanted to ask you is, where do you see silver going in the short term?
Well, you know, in my business, win, lose, or draw, we get to make our living by a lot of things, and basically really what we make our living at is stock analysis on the mining equities and our calls in the market, of course, because I do give people the benefit of my timing and basically how I arrive at that. I think that, one, that the mining equities have bottomed. If you take today as an example, as we're doing this interview, the mining equities had a very strong day today while the metals were flat. And as I have taught my members and, you know, people that get the benefit of my free stuff like we're doing today, learn that the mining equities usually lead the the metals themselves. Not always, but quite often, especially in a bull market. So I think the mining equities have bottomed a few months back, and I also believe that the metals have bottomed. Now, that's a little tougher call because we just don't have enough time behind us to say that, as it's easy to see the bottom. In retrospect, call it real time or close to is pretty difficult. Nonetheless, where I see it, I see that we're going to start building a new base in this range. I think it's going to take time. I think we're going to have to get through the rest of the month of August, probably most of September. I think by late September, early October, we'll start to see the base move higher, you know, above the $30 level for silver. And then by the end of the year, I wouldn't be surprised to see 35, even to 40 on the silver market. So I think the worst is behind us. And I think we're going to build a base further along and actually end up with, pretty decent prices by the end of the year. Certainly not my earlier prediction like in January and February of 2012, where at that point in time, based on the data available and what I saw in the global economy, I thought we'd actually be stronger than we are. But these markets, when they go parabolic like silver did in April of 2011, and we went basically from the $26 level to the $48 level in a few short weeks. Even as much as I love silver, when you see those kind of market moves and the kind of momentum and then 5 increases in the margin requirements from the CME to, quell the market, if you will. And then what happened, as you mentioned, on the 29th of February, while the Bernanke was being shown a piece of silver, and this market was taken down substantially. All those things factored in. It takes time to rebuild a base, and quite honestly, in those kind of situations, and from my experience of 4 decades in this market, it usually takes somewhere between a year or 2. Now, I'm not forecasting 2 years. It's been over a year. I think it's enough. I see it as building a base here.
All right, yeah, you've been talking about, let's say, September and October, where gold and silver may go up, and I do agree with you that that could happen, and here's the reason why, and I wanted your take. First of all, Indian wedding season, I believe, starts in September or October of this year. And then you could have a potential debt ceiling hike. And then 3, the problems in Europe. And I don't want to sound like a conspiracy theorist, but these markets usually blow up in, let's say, September or October, let's say the stock market. And we could have a crash. I don't know. What's your take on that?
Sorry, go ahead.
Yeah. So what's your take on all of these issues then? I know I talked about it a lot.
That's good. I don't mind compound questions. I usually throw them out myself. It's better to ask one at a time, but I got it. I think in most circumstances when you get a large sell-off in the major equity markets, not in the mining shares, but the general equity market, like the DJI or the S&P or whatever, normally the mining shares go down with it in sympathy. This time I am pretty convinced that that won't happen. Here's what I think would happen. In a major sell-off of the general stock market, the mining shares might go down and do as bad as a double bottom. In other words, a bottom I've already called, it might test that one more time. That's the worst I see. You've got to remember that gold is the most negatively correlated asset to the stock market. None other is more negatively correlated. So when you get a down stock market, you get an up gold market. Now, does that mean that day or the day it's selling off? No, it doesn't. I think most people listening to your show realize in a major sell-off that all the paper gold that's out there, not all of it, but a great percentage of it, gets sold along with the falling stock market because everybody in the game is leveraged to the hilt, and the fund managers have got to sell whatever they've got, and gold being, one of those assets. Nonetheless, gold stocks, although they're not as negatively correlated to the stock market as gold is, do act like gold eventually. And in this market where things are happening so quickly, I really see it having a very little effect on the mining shares this time around. Now, I know that's contrary to what I've said in the past, but I've told that to my members month after month after month now. I think I've tried to emphasize that over the last 3 reports. Not to worry. Now, does that mean I'm right? No, it doesn't. Time will tell, but I'm pretty confident in that statement. So I see it a little differently than it's played out before. I think if you do get a large equity sell-off, the mining shares will probably hold their own, maybe even go up slightly. And if that would confirm or vindicate what I'm saying and what I've studied in the past and I project for the future, that is like, if you want a sure thing, that's the time to get on board some of these mining equities that have been beat up for so long and so badly. Because if you really want to make money in the market, you've got to think like a contrarian. And since we're in the precious metals, you almost have to think like a criminal. And I'm sure you mean, well, what do you mean by that, David? And what I mean by that is you've got to think about the other side. You've got to think about the Goldman Sachs. You've got to think about the JP Morgans. You've got to think about the CME. You've got to think about all this nonsense that goes on in the precious metals arena and others, but particularly in the precious metals, and try to outthink these guys. So that's my take on it. I know I sound extremely bullish. That's because I am extremely bullish.
Yeah, speaking of JP Morgan, I've been hearing a lot of things about maybe JP Morgan, maybe some other investment banks, let's say, rigging the bond market. Whether or not that's true, we do notice that the 10-year for the American bond market, I think 1.60% or around that range. So, number one, do you see a bond bubble forming as many, let's say, hard money guys are talking about? And do you think that this is going to wind up, let's say, in hyperinflation when this bubble does burst, as some people are predicting?
I gave me another compound question, but that's okay. I'll quote myself on the bond market. I have said to my members, and I don't think I've said this one in public before, but I'll be happy to, that I think there will be more money made by shorting the bond market than anything else you can do in the next, probably over the next generation. In other words, if you're taking a slice of 25 years or 30 years, you're probably going to make more money shorting the U.S. bond than anything else you could do. But I do not see a hyperinflation. The reason for that is, and I see inflation, but not hyperinflation. And, of course, that's hard to, what is it? Well, you have to define it. But I'd say anything above 20% inflation and on an annual basis would be hyperinflation. You could argue that. The point I want to make is this. In advanced capital markets where you have an extremely strong bond market, meaning there's so much paper flying around, which there is, we all know, anyone that's listening to your show knows what the debt situation is like, so I won't even go into that. But you got to remember, as interest rates go up, bond prices go down. That's what Volcker did in 1980, is he actually sent the yield on treasuries at all levels, T-bills, T-notes, and T-bonds, through the roof. And that, of course, made massive deflation possible in the bond market, because when the interest rates went sky high, the value of those bonds went very, very low, and that takes a huge amount of money, quote-unquote money, out of the system. That couldn't happen this time. You would crash the market beyond belief. It doesn't mean you won't crash the market even with a subtle raise in interest rates. But the point is that as interest rates are forced higher, the Fed does set the discount window, but they do not actually control interest rates. They do a lot of jawboning and a lot of persuasion, and they've got their tools and they've got their ways to work in the futures markets, and they've got a lot of abilities, but they're not omnipresent and omnipotent. They have weaknesses. So the market itself could send the interest rates higher and the bond prices fall off. So because of that fact, I don't see us necessarily going into quote-unquote a hyperinflation. But what's going to happen is that, look, the paper gain is basically over. In fact, it's been over for quite some time. So you have two default mechanisms. One, you could default on the bonds and say all this debt that's out there will never be paid back. Well, guess what? That's the truth, people. Everybody that knows anything about finance knows that's the truth. The bonds in the U.S. won't be paid back, or in the Eurozone, or in Zimbabwe, or anywhere else. Zimbabwe didn't have bonds. I'm trying to be a little facetious here. The point is, none of this can be paid back. So that's a fact. So either the bonds are defaulted upon, or the currency is defaulted upon, or both could be defaulted upon. So you could have the bond market crashing, lots of deflation, quote unquote, because the value of your bonds being worth 1,000 face value is now worth 500 in the market if you got to liquidate it. And people are saying, you know what, this currency's failing. I don't want this currency. So you could have a huge rush into things. And what are things? Well, things are jars of peanut butter. They're, gallons of gasoline. They are gold and silver, which is the top asset class of any tangible. So this is what I think is going to take place. And what I've tried to emphasize on your shows and others is that you'd rather be 6 months too early than 6 minutes too late. Because I think once the psychology changes and you see a shift in the bond market, you're going to see a rush like you've never seen before. So I'll just repeat what I started with. I think there's more money to be made shorting the U.S. bond than anything else you can do.
Yeah, I totally agree with that, David. And before I let you go, how can people, let's say, do business with you and follow your own work?
Well, thank you for that opportunity. First of all, let me just tell you what there is for free, and that is just to go to the website, themorganreport.com, and sign up for our free weekly updates. And I'm very generous on those. Basically, I give offers on coin dealers that I know and trust. And sometimes I even give a further discount to that list. Not always, but I always feature. It's not a weekly thing. Every week I put out some economic data for everybody and let people ask me questions and I answer them. Above and beyond that, we associate with some good coin dealers, and that's free. Also, there's a YouTube channel called Silver Guru. That is free. And then on Twitter, it's Silver Guru 22, and that's free. So those are all three things you can do to follow what I'm doing. And it's not just me. I have a very, very bright staff that's worked with me for a very long time. And the people behind me probably make me look better than I would be on my own. And I don't mind saying that. It's the truth. As far as people that are serious about this market, then the Morgan Report has three levels of service. That's a beginner, basically, or called basic service. There's a basic plus trading where I show you the trades I'm making. By the way, I have gone short on the bond a few times and missed it, but I've done it very carefully, but I've only used options so far. I haven't gone in fully on the futures because that's so tempting. But nonetheless, it's right, but didn't turn out. So anyway, that's just an aside issue. And lastly, there's a mastermind series for basically hedge fund managers or very high net worth investors. Sometimes we'll put an opportunity out there that's higher risk than would be appropriate for our basic people. But that's not primarily the point of the service. There's all kinds of things I come up with on a monthly basis for that group. All of that's available on the right-hand side of the website. I did a video on each one of those services. If you want to really dig in and see what you're going to pay for, you can take the time to watch those videos, and you'll know what you're going to get.
All right. Thanks for coming on again, David.
My pleasure. Thank you.